this question. Part A, let me handle that. It's kind of theoretical. Either you know or don't know. Are you clear now? Okay. Part B, on 1 December, Ambush sold goods on credit on tray of 600,000. Well, when you do a sale on credit, you debit your receivables, credit your sales. Okay. That's the first thing you should have picked up. Did you do that? First thing is recognize the receivable, receivable and revenue. Are you clear now? Got it? Trade has a credit limit of 60 days, which kind of means that if you sell on 1 December, the due date is when? By when must you pay? Well, it's supposed to be paid on 31st January 20x5. This is something you should have picked up. Are we clear? Once you pick that up, then it becomes easy for you to actually interpret the question. Ambush applies IFRS 9 financial instrument and uses a predetermined matrix for calculation of allowance of receivable for allowance. Now remember, for receivable, there is two ways or two treatments allowed by IFRS 9. One is give full allowance, which means follow level 1, 2, 3, or the other one is basically to look at it and give it lifetime. It's called the simplified approach. Got it? Okay, you have to write that down later on. Okay. Then you got days overdue, nil, 1%. That means no days overdue. The standard expected lifetime loss is 1%. Then once it's 1 to 30 days overdue, the lifetime expected loss goes up. Notice this is lifetime expected loss. This is not movement between level 1, 2, 3. Understand now? This is that your lifetime expected loss goes up. Okay, so they have 5, 15 and 25. So they have a flat lifetime rate. Are you clear now? It's not level 1, 2, 3. Okay, trade not paid by 31st January and so failed to comply with credit terms. Ambush learned that trade is also having serious cash flow difficulties due to loss of key customers. Financial control trade has informed Ambush that they will receive payment and ignore tax. Okay, show accounting entry 6 months only to record the above. So in this one, to handle how you handle the question, you might start with a little bit of theory all the time, but usually, okay, just talk about it this way: receivables. Just put that down. Put it as a header and say, well, as long as they do not have a financing element, simplified So I'm just going to put in this case. I think you've seen that in my answers sometimes, right? Yes, no? I'll say in this case, the ones on the video online. Have you started looking at that? You should start a bit, okay? And because those questions I do there, some I'll go through again, okay? But I won't go through the same question 2 and 3 because I think that one you need to go through as many as possible, not as few as possible. So I will try not to repeat question 2s and 3s. But I will try question 1 and 1 I might repeat it. Because the way I did it that time was I'll do partial. Clear? So question 1 I might repeat, but question 2s and 3, the ones I've done on the videos is what you have to watch first. Okay, does that make sense to you? That should increase the volume of practice you got. And remember that when you do those questions, the way to practice it is like this. You do the question first. You try at it first. You give it a try first before you look at the answer. And usually auditing answer is a very dangerous strategy. Yeah? You know what is auditing answer, right? Yeah. Auditing is like, I read the question and I look at the answer. Oh, that's how they do it. Okay, fine. That is a lousy strategy. Because remember, your main aim in doing question is not to learn the answer. It's about learn how to make judgment. That you must always remember, you are there to learn how to make judgment. Does that make sense? The only way you learn is by doing the judgment and then seeing it's right or wrong. Follow, don't follow. If you keep looking at the one, it's like a pilot. Right? You can't look at it from hindsight. You know what is mean a hindsight now? The moment you see the question and then you see the answer, you're looking at it from hindsight. You're looking at it backwards already. Not a good idea. You're always supposed to train your mind to look forward. And you must make your mind become daring to just commit answers. Because you know what's the problem with a lot of students? Slow in writing answer because thinking too long. You know, like, right or wrong, can, like this also can, like that. So thinking too much. So instead of thinking too much, you must learn how to like, shoot. Go in and shoot as many points as possible. See how many hit. Then you see your judgment improve. Are you okay now? So that's a strategy. Not really. If you know that the important thing you're learning is judgment and your knowledge is background, you will get the skill. You keep on auditing answers. That's a scary one. I repeat again because I've already seen the ratio. Those who audit answer tend to fail. Those who audit answer, I'll ask them, did you do all the past questions? Yes. How did you do it? Oh, I just look at the answer. That's why I fail. Then those who practice the question, pass. Okay, clear cut. That one is clear cut. So you just have to learn. In this case, 1 December. What are you going to do? 2000x4. Okay, done. That's all you're supposed to have done for this question. Are you clear now? Follow? You must automate it. Yes. They already stated what? Nil. 0 days is nil. In real life, the matrix is based on your assessment of your history. It's basically not historical cost, your historical bad debt trends. So you have to build your bad debt portfolio matrix. Basically, you have to build up. But if somebody doesn't pay by which day, how much is your expected? You have to start expecting your probability of loss. This one you have to do some mathematics to prove, because the auditors will ask you, how did you prove this? And then you have to just say like, okay, this is the way we calculated this is the basis. So you'll use some averaging, average bad debts and all that, and then estimate them. No, you have to provide. If you move, once IFRS 9 is implemented, have to provide. There's only two choices, either using full or simplified. The full method means you do level 1, level 2, level 3 for each receivable. Very tedious. Then the simplified is this. This is simplified. So you have to build a matrix. Yeah, it is the most easiest way, or not the most hardest way. The other one is more harder. You have to do credit evaluation for each of your customers and look for credit, quality, credit assessment. So you have to make a credit assessment on each customer. You can adjust by profile. You can then create by profile A, this is our matrix. Profile B, this is our matrix. Profile C, this is our matrix. Are you clear? That's how you can do it. Alright? Okay. Now, the next one. Let's look at the next one. The next one you got is Ambush is reviewing accounting treatment for its building. The company uses revaluation model. That's fair value through OCI. Remember that? Okay. For its building. The building had original cost of 10 million on 1 December 2003 and had useful economic life for 20 years. They're being depreciated on straight line basis to nil residual value. Okay. The buildings were revalued downwards on 30th November 2004 to 8 million, which was the building's recoverable amount. On 30th November 2005, the value of the building had risen to 11 million, which is to be included in the financial statement. Companies are unsure how to treat the event. How? This is complicated. How? This one you have to do a table. I got asked you to do a table before. Okay? I'll do the workings first for this one. I'm not going to write this one first. I'm going to put item. What's the date? How many dates you have there? Look at the dates first. 1 December 2003. Next date is what? 30th November 2004. Then the next one is I always put this line first, called the original line. Remember this one? Put the original in. How much is the original? 10, right? How much is the at year end here? How much should it be valued at? 9.5, and the next one should be, I think this one should be 9, right now. This is the easy one, yes, no? Always plug in the original book value based on original depreciation. Are you clear? Worry about the original life of the asset first. Okay? That should be easy. Just figure out the depreciation and charge it in. Are you clear now? Careful for years, the gap sometimes might be longer. Got it? Okay. Just follow the standard depreciation charge. And after that, this one has a down and then a up. Okay, it went down to 8, wasn't it? Yes, no? It went down to 8, correct? Okay, so how much is it here? Now you have to revise the depreciation charge and calculate a new depreciation charge. If the value is 8, as at 30th November, how many years left in your useful life? 19. So how much is your depreciation? 0.42. Therefore, the value here should be 7.58. Okay. Can you get that one please? Yes, no. Now you go up to are you okay? This one is down, then up. Are you clear now? Down, then up. Gain of how much? 7.58 to 11 is how much?
3.42.
So that's going to gain of 3.42. So first one is 1.5, right? Correct? Went down 1.5, now go up 3.42, correct? Yes, no? Okay, huh? So from here to here, how much?
7.5 to 1.9.
9.
1.4.
Are you okay?
First 1.5 minutes has to be in it.
That one is 2000 X4. Okay now. Clear? That should cover that one. Okay, now I do part A. About the impairment of financial asset. Okay, do you understand this one? Yes, no? Yeah, because you see, if there was no impairment, how much is your depreciation? 0.5. Now, because of the impairment, your depreciation is how much? 0.42. So you have reduced impairment, reduced depreciation because of the impairment. So now you have to think about that extra 0.8, right? 0.08, 0.42 minus 0.8. That's why it coming here, you can see now. You don't reverse 1.5. That depreciation had been reduced a bit by 0.08.
So we need to say depreciation has to be charged as normal.
It'll be like as if normal. That's why it comes through still.
At the reducing rate.
At the normal rate, at the actual rate. It must, yeah. You should take into account an actual rate, not at the reduced rate. Although when you charge depreciation in the P&L, it's at the reduced rate. But when you reverse, then they will say, take back your normal depreciation. Does that make sense or not? You have to take back your normal depreciation because right now, from 1.5, you impair 1.5, right? Because of this impairment here, your depreciation becomes 0.42, correct?
You need to say, sir, it's compared 9 and 7.5.
Yes. You compare these two to get 1.42. That's why you're going up this way. You already learned that if I was to reconcile it, it's because of a lower depreciation. Does that make sense to you? Okay. So that's why it comes back this way and then you go up that way. So from here to here is P&L. From here to here is OCI. This is the line I got teach you before. Remember, up, original, down. Anything below the original line will always be running in P&L. Anything above the original line is always running in OCI. Can you remember that rule? Most important is establish the original line. If you don't get that original line set up properly, then you got a problem. Okay. Are you clear on how to handle property revaluation? Yes, no? Can I? Your available and reasonable and supportable information available without due cost. interest gross means you calculate the gross value, like if your debt is 600,000, you calculate on 600,000. ECL could be, let's say, 50,000. Okay, so it's 600,000 times, let's say, the interest. Then stage 2 is still on 600,000, but the ECL could go to 100,000. Okay, stage 3, the interest is calculated on the net amount. That means 600,000 minus the ECL times the interest rate. That's the meaning of net.
The ECL from stage 2 is
ECL from stage 2 lah.
not from stage 1, right?
Not from stage 1. Stage 1 is 12 months. Stage 2 is one lifetime. So it's always higher. Are you clear now? Done. Right. So you now get the idea of how to handle this question. Yes, no? Can? Can understand? Cannot understand? Can, huh? Okay. So that gives you, I repeat, that gives you the approach for handling this question. Alright? Can I move on? Can? It's not so bad, right? Don't try to memorize too detailed. You just need to memorize the principles. Okay, you do need to recall principles. After that, you apply the principle. Just scatter the principle inside as part of like the idea for it, and then straight away get in. And I think you've seen some of the answers. I've given backup answers for it, like how to write a backup version of the answer. Yes or no? You go through the online one. I'll say like this one, you can use the backup version. The backup versions is what you need to learn, because from what I heard from the students who passed last round, some students just went backup 100%. They said they didn't write any accounting standards at all. They said they couldn't, this guy is really lazy lah. They didn't want to study any accounting standards. So he just mastered the backup answers and went in with pure backups. Pass. But your console must be good. Your console must be reasonably good, then the backup will pull you through. Got it? But if your console is weak, then you better have a stronger answer in your question 2 and 3. You can't use the backup all the way. Are you clear now? But the backup can be used to add on points just in case. Understand? Add points, more points. Don't like, they ask you for 7, don't just stop at 7, maybe give 8 or 9. Two are backup answers, points there. Are you clear now? Got the idea there? Like this is the backup answer, you can see now. I'm using the cost constraint as a way to explain why is it they gave an exception. Make sense? Okay.